Let's talk about accounts receivable. We know that accounts receivable arise from the selling of goods or services to customers on account. We know the entry is debit accounts receivable, abbreviated A/R, and credit sales. The amount is always the face amount that will be collected, and that's because it's a current asset and you'll be collecting it quickly, or at least that's the assumption. The trouble is that not all customers pay, and so we always are very interested in figuring out what the net realizable value is of those accounts receivable. And so these will be called net accounts receivable, or it'll be called its book value. And how we get the net realizable value, or the net receivables, or the book value, is it's going to be the balance in the accounts receivable account minus the allowance for doubtful accounts or bad debts. We'll just call it bad debts. And that's an estimate based upon our previous experience about who is not going to pay. We don't know what their name is, but we know they're probably not going to pay us. The other thing that you have to be aware of is that you may not collect all of your accounts receivable because you may offer terms to your customers for paying fast, and those are called sales discounts or cash discounts. You could also have customers returning things to us, which are called sales returns, and we could also give some allowances such as a rebate, a coupon, or something like that, and those are called sales allowances. So the other term that you'll hear me talk about is net sales. And net sales means the sales that stuck with the customers. That's the sales less the sales discounts, the sales returns, and the sales allowances. So net sales is sales minus numbers 1 through 3. So net sales are the sales that stuck. The uncollectible accounts receivable, the bad debts or the doubtful accounts, is what is subtracted from the accounts receivable, in other words, the running tally of which customers owe you money. And that's different because sales discounts, sales returns, and sales allowances are all contra revenue accounts, meaning the sales that don't stuck, whereas those uncollectible accounts receivable through the allowance for bad debts, doubtful accounts, or uncollectible accounts is a contra current asset account because it's subtracted from an asset. So that's the difference there for the accounts receivable. Now, we're going to go through each type, and so the first type is the cash or the sales discount, and those are offered to customers to entice them to pay you early. And so the terms examples of the terms would be things like 2, 10, and 30, which means if you pay within 10 days of the invoice, you get a 2% discount. So instead of having to pay 100% of the bill, you only have to pay 98% of the bill. And the net 30 means that the whole bill is due within 30 days. So that's one example. Here's another one, 210 EOM. That means you get a 2% discount if you pay within 10 days of the invoice, and the whole bill is due by EOM, which stands for end of month. EOM, E-O-M, end of month. So there's two different approaches to handling these credit terms or these cash or sales discount terms. The first method is called the gross method, and in the gross method you assume nobody will take the discount. Assume no one will take discount. And the net method, where you assume everyone's going to take the discount. Assume everyone will take the discount. So let's look at a couple problems, and we'll go through them, the gross method, the net method, and then we'll do another problem where we'll do the gross and the net side by side.